Tuesday, October 24th, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look back at recent history. We're going to look at the country, the only country that did the right thing after the collapse of 2008. Yes, there was one country that did the right thing, and we're going to reference The Price of Time by Edward Chancellor. And again, I'm going to keep harping on about it. I don't have a deal with this guy, but I think you should read this book if you get a chance. If you want to understand what's going on in the financial, monetary world, and even economic world, I would say. But before we look at this country that did the right thing, just talk about a couple of things. The first one is I received yesterday a letter from NatWest, my credit card provider. And by credit card, I don't mean debit card. Do I use my credit card? Sometimes, but only for transactions that need to be insured sometimes, like when you buy an airline ticket with a credit card. They have some good provisions there that allow you to, they insure if for some reason the flight is canceled, they will pay it right back. But if you pay it right away, you have to go to the airline, and it might take months. I remember back in 2020, I had booked a flight to one of the Baltic countries via Air Poland to go to a wedding. And because of lockdowns, everything was canceled. I had to wait like 6 to 9 months to get paid back. So there are times when it's okay to use your credit card, and when I use it, I pay it right away. I don't use it for credit. And the other time that I use it is when I get a letter from them saying you haven't used it in too long, we're going to cancel it, so I'll just spend something on it, pay it right back. But yesterday I got a letter, and it says, you can see here, there you go, your credit card interest rates are increasing from 19.956% to 22.44. So it's increasing by 2.5%. You can see here. So why am I showing this? Well, because I think it shows that the consumer is going to get more and more, ripped off, I would say. The general public is going to have a much more tougher time, not just with the mortgage rates, but also with credit card rates. I'm going to do a video soon about usury, because there are many who think, usury is wrong, that this kind of rate, 22.5%, is usury. But there are two sides to the coin, to the question of usury. And I'm going to do a separate video about that. So the other thing I'd like to say is that I spoke to Oliver Temple of Gold Investments, and they still have the 5% off from various dates sovereigns on their website. You just need to use Monaco 64 SOV promo code. For all the other coins and bars, you need to still use Monaco 64, and you have to do a separate transaction if you want to get that 0.5% off. And of course, for all my viewers in the US, I'm sure ITM Trading and Miles Franklin can provide you some good deals these days. You just need to contact them and tell them that I sent you there. All the details are below in the description. So back to the country that did the right thing. In the aftermath of the '08 crisis, and many of you have probably watched The Big Short, which is a great movie about the '08 crisis. I highly recommend it. And towards the end of the story or the movie, one of the characters says, the main characters, or yeah, it's something to the effect that, well, after all the crisis, all these bankers were arrested, people were compensated, justice was done, and all the banks were like taken over, reorganized. And then it says, no, I'm sorry, only kidding, right? So nothing was done in the US, nothing was done in the UK. But there was one country, and now I'm going to tell you what country it is, Iceland, who didn't do any of that. And Edward Chancellor talks about that in his conclusion. And I think it's really important to look at it, especially due to the fact that he's talking about it and he's made it a part of his conclusion. And he calls it the Icelandic counterfactual. So here it is, Icelandic counterfactual. So I'm going to go through it, and so you can have an idea what the Icelandic government did. In the aftermath of the global financial crisis, central bankers asserted there was no alternative to their policy of slashing interest rates, quantitative easing, and protecting banks from failure. Had they done otherwise, they claimed unemployment would have reached Great Depression levels and inequality would have climbed even higher. Yet Iceland's strong recovery after 2008 suggests otherwise. Credit conditions had been more extreme in the island nation perched on the edge of the Arctic Circle than anywhere else in the world. The country's three largest banks, Glitnir, Landsbanki, and Kaupthing, and interesting that we had some of these banks as clients at MF Global. Just a little anecdote there. Accumulated assets close to 10 times Iceland's national output. Their foreign liabilities were off the charts, cut off from the capital markets after Lehman's bankruptcy. The Icelandic banks were not too big to fail, they were too big to bail. Unlike several other central banks, the Icelandic Central Bank didn't receive dollar swaps from the Federal Reserve. There was no quantitative easing or interest rate cuts. Instead, after the Krona collapse on the foreign exchanges, losing around half its value relative to the dollar, inflation took off. Capital controls were imposed in 2009 to stop money from leaving the country. The ICB was forced to raise interest rates, which later peaked at 18%. Iceland received emergency loans from the IMF and Scandinavian neighbors, and in return swallowed the bitter medicine of austerity. Savings went up, consumption went down, taxes were raised, government spending was cut. Iceland's banks were dismantled. Their domestic deposits and loans hived off into new banks that were supplied with fresh capital by the ICB, or their central bank. The old banks were left with foreign assets and liabilities and wound down. Debts were restructured, written down, or forgiven. A new law required the old banks to pay a stability tax equivalent to 39% of assets. In the end, foreign creditors took voluntary haircuts. Homeowners whose properties were valued at less than their mortgages received tax relief. A court ruled that foreign currency mortgages were illegal. The government helped borrowers who had inflation-linked mortgages. In some respects, the Icelandic approach to their debt crisis harked back to the debt jubilees of the ancient world. The IMF noted that by 2015, the year in which its loan was repaid early, Iceland's economy had returned to normal. By this date, Iceland's GDP had returned to its pre-crisis level. Inflation was under control. Interest rates were down. The housing market had recovered. The banks were well capitalized. Nevertheless, the crisis had a profound impact on financial activity. The ICB reported that deep and long-lasting behavior changes prompted by the traumatic experience of the financial crisis resulted in greater prudence, a strong propensity to save, and less leveraged growth. Iceland turned into a savings geyser. By the end of 2017, private sector debt had fallen to less than half its peak level. Government debt, which rose to 95% of GDP during the crisis, had also halved. Both the current account and the fiscal balances were in surplus. The financial sector didn't contribute to Iceland's recovery, but continued shrinking. Instead, new growth came from a variety of sectors: tourism, renewable energy, and technology. While the rest of the developed world was engulfed in an intractable pensions crisis, Iceland's private retirement savings comfortably exceeded national income. A decade after the crisis, Iceland's GDP was 15% above its pre-crisis peak, a better performance than in most of the developed world. In 2018, Iceland claimed 7th place in the OECD's ranking of output per capita, up 4 places since 2007. As the economy shifted away from finance, it became more diversified. As debt levels declined, they became more sustainable. During the crisis, Iceland's unemployment rate hit 9%, around the same level as that of the United States. But unemployment soon fell back to its average level. As for inequality, Iceland's Gini coefficient for incomes declined after 2008. Iceland is a small country that benefited from a massive currency devaluation. The option wasn't open to every crisis-stricken country. Still, Iceland's experience shows that there was an alternative to slashing interest rates and protecting the financial system at any cost. Iceland's answer was to let the banks fail. Prosecute miscreant bankers. 24 of them were sent to jail. Yes, Jamie Dimon, listen up. And shelter domestic depositors and homeowners at the expense of other creditors. The U.S. approach to the subprime crisis was the opposite in almost every respect, well, the UK's as well. It would be a big mistake to go into the next crisis equipped with the same tools and mindset that failed to restore our economies to health after '08. In the early 1930s, Hayek, that's the guy who wrote The Road to Serfdom, argued that the cure for a credit boom wouldn't come from lowering interest rates or by running large fiscal deficits. If interest rates had been too low before the crisis, then reducing them further was not the answer. It's just common sense. Instead, he believed that interest rates should be allowed to rise along with savings, which had been too low beforehand. Bad investments should be liquidated, he added. The Austrian economists failed to convince people at the time. Yet Iceland adopted many of Hayek's prescriptions out of necessity rather than ideological fervor, and emerged from the crisis in better shape than most. Hayek didn't believe that economies lent itself to real-life experiments. Still, he might have felt vindicated by this outcome. Towards the end of his life, the veteran economist visited Iceland. It was suggested to him that economic principles didn't apply to a small country like Iceland. Hayek disagreed. Economic principles were valid everywhere, he said. So there you go. And of course, when he went to Iceland, it was way before the crisis. But I thought this was really interesting. And I remember very well one of my neighbors, he had an account with a bank called Iceland. And Gordon Brown basically used Anti-Terrorism Crime and Security Act of 2001 to basically take over all the assets of this foreign assets of this Icelandic bank to bail out all the depositors in the UK. So that's what politicians in the West did. They did the wrong thing. Of course, the Icelandic banks did the wrong thing, and I think the Icelandic government did the right thing by punishing them. So yeah, the story is here. I'll put it up. I'll put it down in the description. The story about Gordon Brown and how he bailed out depositors, and it's called "I Save a British Perspective." And you can read this, and some of the UK depositors who were interviewed said, "Yeah, it was the right thing to do. Why didn't Iceland bail out its banks?" So you can see what the mentality of the people in the UK and in the US was, and probably still is. The thing is, we expect bailouts. The Icelanders didn't have a choice. It wasn't because of they were Austrian thinking, Austrian school thinking. It's just that they had to do it. They had no choice. So read this article. It's quite interesting. And so there you go. When they tell us that they had to do that, mention Iceland. If anyone says, well, they had to bail out the banks, you can mention the example of Iceland. So let's quickly look at the markets. It's 8:30 a.m. London time. Yesterday, the 10-year yield actually traded even higher after I spoke. I think it was around 498 when I spoke, and it went up to 502. And then all of a sudden, it just collapsed. I think right now it's around, let's see, where's the 10? It's around 481. So it's come off like 20 basis points. And why is that? Has anything changed in terms of the debt situation, the deficits? No. It's just that some big hedge fund manager called, I think Ackman, I forgot his first name, he's come out and said, well, I'm closing my short position on bonds, and all the lemmings followed. They call them CTAs. They're commodity trading accounts. They're like funds that, trading funds apparently are following him now, and they've gone long bonds. Do I think this is it? The bear market in bonds has ended? No, nowhere close to it. I think this is going to be taken as an opportunity to sell again. And Mr. Ackman, I think he might have made a good profit on his position, but I think he's going to be too early in the medium to long term. I think yields are going to go a lot higher. So let's get to the markets then. We've got spot gold at 1976. It's up just over $3. High's been 1981, low 71. So it's holding pretty steady, gold at the moment. Spot silver is up 14 cents at 23.10. The high's been 22 and the low 91, 22.91. The Dow futures is up 88 points. The Nasdaq is up 106. And the S&P is up 18. Yeah, the dollar dropped a little bit yesterday. The euro and the pound rebounded slightly. Right now, the pound is up just over a tenth. It's at 122.67. The euro is unchanged, 106.64. The dollar is a little lower versus the yen. It's at 149.40. And the dollar's unchanged versus the yuan at 731. Aussie dollar is up just over 0.5% at 63.72. The dollar's down 0.1% versus the Canadian dollar, 136.70. And the Kiwi dollar is up 1/3 at 58.66. To the commodities, WTI crude is up 2/3%, just below 86. Brent is trading at 89.50, up 2/3 as well. Platinum is up $4, trading just above 900. And high-grade copper is up 1/3% at 362. As I said, the 10-year yield is now back to like 480. I mean, the other thing as well, maybe a correction was due. But as I said, this is a bear market, in my opinion, medium to longer term. So, yeah, buy the dips or sell the rallies, I would say. For buy the dips in the yields, sell the rallies in the price. What about the UK rates? The 2-year yield that's come off as well. It's at 480. So recently we're above 5%. And the 30 years back down to like 502. So this rally in the U.S. Treasuries is helping gilts as well. So with that, I'm going to wish you all a very good day. Take care. Bye.